Well, good morning. Jayendra Rana here. The topic of the day is deciding sum insured in life insurance policies. Deciding sum assured in life insurance policies. It's important to have term life insurance if you have people who depend on you financially. If you unexpectedly pass away, your loved ones might struggle to cover their living expenses, debt, and future plans without your income. So, term life insurance provides a one time payment to help fill this financial gap and support their stability. So, how much money will your family need if your income stops? The life insurance rule recommends having life insurance coverage that is at least 10 times your current income. This amount should consider all your debts and loans. This rule helps determine the amount of income your family will need to cover their daily expenses if you are no longer there. Say if your annual income is rupees 5 lakh, you need rupees 5 crore of life cover so that your family does not face any financial difficulty and can continue with their current lifestyle even in your absence. So, remembering that your income will change over time is important. So, it's a good idea to review your life insurance coverage every few years. This is a crucial part of ensuring the financial security of your family in the event of your unexpected passing. Now, the question is how to calculate minimum sum assured. So, to determine the minimum sum assured needed from a life insurance policy, you should start by calculating your annual income and the present value of your long term and medium term goals. Then subtract your current liabilities from the minimum sum assured by the life insurance policy you are considering. So, the total of your long term and medium term goals, present value, and annual expenses equals the sum assured offered by the life insurance policy plus your current liabilities, then it is advisable to choose the insurance policy. So, choosing a life insurance policy is a critical life decision. However, it is not the only factor to consider while selecting life insurance, because there are some suggestions for choosing the best life insurance coverage according to the various comparable insurance websites. So, first of all, consider your budget, because the term insurance offers high coverage at affordable premiums. But choose a plan you can comfortably maintain without straining your finances. Then compare different plans and providers. Do not settle for the first option. Research and compare quotes from different companies to find the best coverage at a competitive price. Next one is consider riders. Okay, riders are optional add-ons that can enhance coverage like disability income or accidental death benefits. So choose riders that complement your specific needs. And buy term insurance plan online. So buying term insurance online offers convenience, choice and transparency. You can research, compare and purchase policies from the comfort of your home. When choosing a term insurance plan online, consider factors such as coverage amount, term length, and premium affordability. Then review your policy regularly. Always update your coverage as your needs and circumstances change. Also, cost of living adjustments should be considered to maintain adequate coverage. So IRDAI made it mandatory for life insurance saving products to have options of loan against the policy in order to allow policyholders to meet liquidity requirements. So the regulator has raised the free look period, which provides time to review policy terms and conditions from 15 days to 30 days. So the facility of partial withdrawal under pension product is now allowed, enabling policyholders to meet their specific financial needs for important life events like higher education or marriage of children, etc. And on the issue of surrender value, the circular says that in case of surrenders, reasonableness and value for money should be ensured for both surrendering policyholders and continuing policyholders. So a conducive environment is now facilitated to spur innovation, enhance customer experience and satisfaction. If a policyholder wants to exit his life insurance policy during the initial years, he will get a higher refund from the insurance company now. So after several rounds of discussions of the proposals, the IRDA has ordered a higher special surrender value for traditional and endowment policies. Now the policyholders will get a part of his premium back even if he exits from after 1 year. So this will indeed offer more liquidity and flexibility to life insurance customers if they want to switch their policies. So now the question is how to calculate a special surrender value of life insurance policies. Now the special surrender value should be at least equal to the present value of paid up sum assured on all contingencies covered and paid up future benefits such as income benefits if any, accrued vested benefits duly allowing for survival benefits already paid if any. So paid up value is calculated as per a formula, that is number of premiums paid into sum assured upon total number of premiums payable. So to arrive at the expected present value of the paid up sum assured and paid up future benefits, IRDAI has specified a maximum spread of 50 basis points over 10 years GSEC. Let us assume a policyholder pays an annual premium of rupees 50,000 for a 10-year policy term with a sum assured of rupees 5 lakh. Now after 4 years, he wants to exit the policy. After 4 years, he has accumulated a bonus of rupees 40,000 till now. So he has paid a premium of rupees 2 lakh in 4 years. Let us understand how much more he will get as per the new surrender value. So according to the earlier rules, 50% of total premium must be paid if a policy surrendered between the 4th and 5th years, 4th and 7th year. You would have got rupees 1.2 lakh back, 50% of total premium, that is rupees 2 lakh, and bonus is rupees 40,000. So if you had left the policy after 4 years, according to the previous surrender value norms, with this special surrender value norms, now you will get back rupees 1.55 lakh. So higher surrender value when you return policy after 1 year. Moreover, the policyholder will be eligible to get a refund even if they leave after the first year. So earlier, if a policyholder exits a life insurance policy after 1 year, he would have lost his entire premium. Now SSB calculated as above shall become payable after completion of first policy year, provided one full year premium has been received. So provided for policies with limited premium payment term of less than 5 years and single premium policies, SSB shall become payable immediately after receipt of first full year premium or single premium as applicable. IRDAI faced a lot of backlash from consumers advocates for giving in to the demand of insurance companies on guaranteed surrender value a few months back. So with the new master circular, IRDAI has tried to compensate consumers by typing a special surrender value calculation to a discount factor based on GSAC. It's a welcome step and would help end consumers in receiving higher surrender value. So now the life insurance industry in India has been making significant strides forward by expanding access to insurance and making an effort to reach out to areas and segments of the country's population that were previously underserved when it comes to their insurance needs. So it is anticipated that the strong performance can be ascribed to the fact that the life insurers are increasingly focusing on encouraging first-time life insurance buyers to buy essential life insurance solutions, contributing to the 18.58% growth in combined individual PM collection for the month of May 2024. Meanwhile, in the group policy segment, single premium grew by 16.7%. So over the years, you might have noticed quite a few news articles that mention the claim settlement ratio of various life insurance companies in India. This percentage value might seem like one of those states that you read and forget, but it is in fact quite important if you are in the market for a new life insurance policy. So claim settlement ratio or death claim paid ratio is a metric that is published every year by the Insurance Regulatory and Development Authority of India in its annual report for all life insurance companies. IRDAI is actually sourced this data from the public disclosures that are mandatorily published by all life insurance companies in India. So a single criterion like the claim settlement ratio of different life insurance companies for a financial year is definitely not enough to make an informed decision. If you plan to purchase a life insurance policy, there are few other aspects that you should also consider before you purchase a life insurance plan from any insurer. And first of them is to decide the sum assured. So while the concept of claims paid ratio is important for anyone who wants to purchase a life insurance policy, there is one more thing that you should keep in mind. Avoid sharing any incorrect information or hiding details related to medical conditions, financial situations, lifestyle, etc. while applying. So providing false information may lead to your claim being denied, and you might end up in the small number of unpaid claims of an insurer with a very high claim paid ratio. So for every buyer, it is most important while purchasing a new insurance policy, maybe it's a term insurance or endowment or any other products, the sum insured must be adequate and considering his family needs. And it must be decided considering his all personal factors and the future of the family as well as children's. It is always better to take the 10 times of the annual income. Thank you very much.